So you bought some stock, it's gone up. When do you sell?
Not yet. Almost. Now. Sell during an April of 142!
In this video, I'll give you 3 indicators it may be time to sell. Welcome to the Money Growth Academy. My name is Dee. And before we get started, make sure to smash that like button and yes, subscribe, so you can keep up with the latest in financial news, important stock analysis, as well as gain insight to ways to grow your money snowball through the proper mindset, entrepreneurship, and investing. Look, ultimately, the decision to buy or sell is up to you. My goal today is to give you some things to think about when it comes to selling. When you hear the term long-term investor or value investor, oftentimes it gets confused with buy and hold forever. Nothing could be further from the truth.
But at Ford, we believe there is no upper limit to quality. So even though today our quality is 36% better than Chrysler and 10% better than GM, expect Ford quality to keep getting better and better. Have you driven the best-built American cars? Have you driven a Ford lately?
Imagine having bought 100 shares of Ford Motor Company back on February 10th, 1984 for $2.16 a share. To simplify this example, not taking into account dividends and 6 stock splits since then, you might have more shares now, but those shares today would be worth $8.86 each. Not taking into account consideration your money could be elsewhere, earning more. Opportunity costs. Looking back, we can see the glory days would have been between, January 1998 and July 2000. But often less seasoned investors don't see this when it's happening. We all have this belief when we're in the thick of it and the indicators are green that everything is going to go up forever, at least until it doesn't. If you've been listening to us for a while, you know I'm a believer in the mantra, time and market beats timing the market any day. The GE story is very similar. Take a look at their chart. Imagine buying GE sometime in 1999 and still holding it today. A long-term investor is someone that may have a 5-year or more outlook on achieving their desired rate of return. Let's listen to a question posed by Jennifer Rogers from Yahoo Finance to Cathie Wood, ARK Invest founder and CEO, the person people are calling the digital age Warren Buffett.
But how do you know when to sell? Like, in your what advice can you give to people about that? Because I think for investors, it's harder than figuring out when to buy is when to sell.
Jennifer asked the question, when do you know when to sell? For most investors, it's almost harder than figuring out when to buy. You know what? I have to agree with Jennifer Rogers at Yahoo Finance. It can be easier for investors to buy than it is to determine when to sell. There are always 3 dynamics facing an investor, and they're all viewed in retrospect. The first is, I should have bought. The second, I should have bought more. And third, I shouldn't have sold. Either too late, too little, or too early. Let's talk about too little. Warren Buffett once remarked, one of his biggest mistakes, along with not investing in Amazon, too late, was not investing more in Walmart, too little. He has said on several occasions, his thumb sucking kept him from buying more as the price of Walmart shares rose. He estimates that mistake cost Berkshire $10 billion. In 2016, Berkshire Hathaway owned considerable shares of Walmart stock, which it had first bought years before at around $23 a share. But in 2016, it sold about 70% of that stake, worth $3 billion, because he felt the outward pressure happening to retail as a result of Amazon could dramatically impact Walmart's future earnings. At that time, Berkshire Hathaway sold his stake in Walmart. The share price traveled around $66 per share. Today, Walmart trades for about $144 a share, too early. In this table, we've compared Berkshire Hathaway's rate of return to that of Walmart and the S&P 500 over the same time period. We've highlighted in green which investment advantaged in a given year. So, when do you sell? Let's take a listen to how Cathie Wood, as she uncovers 3 vital indicators for when it makes sense to sell. Take a listen.
Yes. Well, we have a very disciplined process. And so our minimum hurdle rate of return for a stock to enter the portfolio is 15% at a compound annual rate over 5 years. We expect the stocks in our portfolio to double over the next 5 years.
Indicator number 1. Let's recap what Cathie Wood said. She said for a stock to enter the portfolio, it had to meet a minimum hurdle rate of return of about 15% at a compounded rate of return over 5 years. So in essence, there's a requirement for a stock to get into the ARK portfolio. Now, this is very important distinction to understand. Although Cathie Wood, as CEO of ARK Investment, has $6.6 billion under management, the strict principle of having strict entry requirements of any stock entering your portfolio is important to have, whether you're managing $6.6 billion or $6,000. All too often, investors lack a solid entry plan when buying a stock, choosing to rely on the price of the stock, responding to the latest media hype about the stock, or just buying because they think it's cool. And if you have little or no criteria for when you get in, well, how would you know when to get out? The next thing Cathie says is that they expect the stock that they bought to double within 5 years of purchase. These are long bets on what I call frontier companies. These are companies carving out the future of humanity. Your EV companies, healthcare tech, genetic technology companies, etc. So if you get to that doubling rate before the 5 years, the goal as stated by Cathie, what should that dictate you should do? Well, let's listen to what Cathie has to say.
Now, when you have big runs, as we did last year, a lot of stocks drop below that 15% as a 5-year expectation. And so when they drop into the 10 to 15%, we'll be taking profits. So we are selling.
Number 2, Cathie said when they, meaning the stocks in the ARK portfolio, drop into that 10 to 15% bucket, we'll be taking profits. What she's saying here is she'll begin to start selling off some of those positions of those companies that have dropped into that 10 to 15% zone anytime within the 5-year period to preserve the cash appreciation. It's called taking the cream off the top to remove the gain from exposure to potential future market risk.
If they're core to our platforms, then we will probably sell, if we think it's gotten way out of hand, we'll sell it down to 50 basis points. We've gone from 10% to 50 basis points in stocks and exiting some as well. Even if they are core, we just think, okay, they're going to need a long time to grow into this valuation. And we don't want to live with or sit with dead money.
Indicator number 3. If it's gotten well out of hand, meaning the market has priced the stock far beyond what is reasonable, well, they would sell off as much as 50 basis points, meaning they would reduce their position to half of what it was. They would exit it entirely sometimes. Why? Because they're going to need a long time to grow into this valuation, and we don't want to sit with dead money, says Cathie. Dead money is money that you have sitting around in an investment waiting for it to come back to where you should have taken profits but didn't. And now you're waiting around for who knows how long to see if it gets back to that high point. Time is money. And a bird in a hand sometimes is worth more than a potential birds in a bush. In summary, the 3 sell indicators are: number 1, have a stock entry point requirement in terms of expected rate of return. What realistic rate of return do you want out of your stock investment? Number 2, have a drop bucket rate of return trigger to sell some or all of your position. You can set these up in your trading account. I do it all the time in my Fidelity account. And the 3rd sell trigger is if the stock price appreciation is out of hand, meaning there's just an oversaturation of buyers of a particular stock, it gets overhyped and the trade gets crowded and the price of the stock gets significantly pushed higher artificially. Consider these 3 indicators as shared by Cathie Wood, and you will find investing, well, a lot more fun and certainly a lot more profitable. See you next time.